What's up, everyone? So today is going to be by far my longest but also my most valuable video that I put on YouTube to date. So this is truly going to be the only video you ever need to watch to be profitable trading supply and demand. I want this to be the foundation for the way that you trade, and I want you to take knowledge from this because there's a lot of BS out there. I want you to be able to trade supply and demand correctly. So I'm going to be taking my 4 years and hundreds of hours of knowledge learning supply and demand, and I'm going to put it into one video. By the end of this, you're going to have an in-depth knowledge of supply and demand. You're going to be able to identify highly important zones in the market that are profitable to trade. I don't want you looking left, right, up, down, seeing supply and demand everywhere. So my intention is for you to laser in and be able to pinpoint the areas that carry the highest value in the market. Now, I know what you're saying, supply and demand is an ICT, but it actually is, okay? Supply and demand is just bullish and bearish order blocks. That's all it is, and I'll show you later on in the video why that is the case. So I've packed so much video and detail into this one video, and every module builds onto one another, so please don't skip any of these modules. I want you to watch all of them so that you learn the full picture. So this video has taken me really long to make, and it covers 8 modules. So strap in, and by the end of this, you're going to have a whole new view on the market and be able to trade it, hopefully, in a much more profitable way.
Just before we continue with the video, I just want to remind you guys to please head down below and give the channel a subscribe if you haven't already. Most of you aren't already subscribed to this channel that are watching this right now. So please do go down below and subscribe, and make sure to leave a comment below letting me know what videos you want to see in the future or what you thought about this video. Thank you very much, guys. Let's continue with the video. Okay, so welcome everybody. This is the supply and demand course. This is the last video that you actually need to watch on supply and demand, and we're going to go through everything in great detail. Again, guys, you need to go through every single module that I'm going to show you right now and watch the video right from the start to the end. There's a lot of people that don't have patience, and that's why they lose in this market, not only because they're taking the wrong setups, but because they literally can't sit through one whole video. So guys, watch the whole video from start to finish so that you can learn the system properly, because I talk about things in the beginning that I build on later. And yes, maybe you've learned about supply and demand already, and yes, maybe you've heard of some of the stuff that I talk about. However, guys, if you skip that part and you missed something that I spoke about that I refer to later, you're going to be completely lost. So watch the whole thing from start to finish. Okay, so there are 8 modules. So the first 4 is the foundation. So you need to watch this first, all right? And the first thing we're gonna cover obviously is what is a supply and demand zone and why it's so effective. Okay. Then we're going to talk about valid supply and demand zones. There's different ways that you can apply this knowledge to the markets. Okay. Then we're going to identify supply and demand. Okay, because there are different ways that you can draw supply and demand on the chart. All right, there's different scenarios that can arise that you can take advantage of. Then we're going to go through real chart examples, okay, of supply and demand. So then we're going to go through it all and identify exactly what we've just spoken about, okay? So then we're going to go on to the advanced stuff, and this is where it gets juicy, guys. You really need to be paying attention at this point, especially, but also before this, okay? So number 5, we're going to be looking at imbalances and fair value gaps. So this is where, ICT and supply and demand trading sort of overlap as well. But again, guys, it's all the same thing. You're trading liquidity at the end of the day. So just bear that in mind. So these added confluences of imbalance and fair value gap are very important, and we're going to go through that in detail. Then we're going to go into supply and demand flips. All right. Now, supply and demand flips are very important and they are a game changer. So you need to watch this part as well. Okay. Failing supply and demand give you a really high probability of a good trade. Okay. And that makes the zone very strong that you're about to trade from. So Then we go on to high time frame analysis and multi-time frame analysis. So this is also vital because, okay, a lot of you guys are trading in the middle of nowhere. You're not looking at what's happening on the higher time frame. And I have a sort of framework that I use to map out my higher time frame so that I always know where my supply and demand zones are that I'm busy trading from. I'm not going to be trading in the middle of no man's land when price has, only just broken out of a higher time frame zone. You do not want to start getting into new positions because you're literally getting in last when everybody else is getting in. Then you just end up being another retail trader. So this is a really key part of the puzzle. Then we're going to put it all together and have a look at just overall different confluences that all work together, all three of these, okay? And then you can frame up trade ideas that really work really, really well. Okay, so now let's hop straight into it. Okay, so what is supply and demand? So it's very simple, guys. So it's simple, guys. When you want to sell something, there needs to be a supply, okay? And when you want to buy something, there needs to be a demand. Okay, it's that simple. Right, so supply is sell and demand is buy. That's how I remember it. S for sell and D means buy. So just remember, if you get confused, supply is sell. Okay, so essentially, guys, what happens is when you buy, okay, you need to have a demand. Okay, what does that mean? So there needs to be a demand, and what determines the demand? It's the price. Okay, so if the price is lower in the market, there's going to be a demand, and then when price goes up, people are going to want to sell. It's that easy. So basically what supply and demand trading is waiting for a better position, okay, to get into the market. And that just simply means if you want to buy the market, you need to make sure that the price has dipped. It's basically buying the dips and selling the rallies. However, it's not just that simple, and there's a lot of people that say, just buy the dip, buy the dip. But obviously, they're going to get wrecked. So if you look at this diagram here, it's essentially waiting for when price pops up like this. You're not getting in here because why? Price is going to come back down. You want to get in right here and take price up. Okay, it's that simple, and that's what we're trying to do. So we're waiting. Once price pops up, we're waiting for price to retrace so that we can get in at a better price. Okay, so institutions, once they see price rallying, they're not getting in up here. They're waiting for price to come down lower so that they can get in at this point where price is in a discounted zone. So what I'm going to do now, guys, is okay, I'm going to give you guys a framework for what people are looking to buy in the market. So big institutions, they're not going to be buying at the top when price is the most expensive. They're going to be buying in a discounted zone. Okay, so simply, if you get your fib or this GAN box that I like to use, and you draw it from the swing low to the swing high, okay, what do you see? Okay, you can see that it's cut in half. Now, what we tend to see, and a pattern we tend to see, is that once price once price rallies, okay, we tend to see that people in the market, so whether it be big institutions, whatever, hedge funds that move the market, demand kicks in once price goes past this 50% zone. So you've got an increased chance of getting a move once price is below the 50% zone. Okay? And this zone here is called premium, okay? And this zone below the 50% is called discount. Now, I don't know about you, but I only want to buy stuff when it's on discount. I don't want to pay an extra fee, okay? And it's the same thing. So basically, the market is waiting for price to retrace till it's in a discounted zone, okay, which will be right here at the bottom of this move for price to continue higher. And so, as I'm sure you've heard before, and even if you are new, price likes to create higher highs, okay, and higher lows when it moves up in the market, okay, and it continues to create higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, okay. And when price decides to change, okay, and go down and turn bearish, it starts to create lower highs and higher lows, okay. So we've got lower lows and higher lows, okay. I don't know if I said that wrong before. Did I say it wrong? So we've got higher lows, okay, and lower lows, okay. So here's a higher low and here's a lower low. Higher low, lower low, higher low, lower low. And that is when the market is trending bearish, okay? And obviously lots of people like to trade trend lines as well, which is an added area that the market likes to target to catch people out, which is why I don't trade it. Okay, so that is essentially what supply and demand is. When the market boosts up like this, okay, and there's a big rally, okay, we then know that institutions are going to wait for price to retrace, and we are getting in at the bottom of where price moved back. Now, another thing to bear in mind, when the price, okay, moves so quickly, and that's the other thing, we want to see price move quickly. So price moves extremely quickly to the upside, okay? It leaves behind what we call imbalance, okay? This move here didn't give people a chance to get in, okay? This move happened so quickly that it left institutions behind. They had no chance to get in. And so what the market tends to do is tends to retrace into this zone and then continues up, okay? And that, in a nutshell, is what supply and demand is. Obviously, it works for when you are short selling as well. Okay, so the price will then skyrocket down, and you'll see an aggressive move, and that's what we want to see when we're trading supply and demand. We want an aggressive move. We don't just want any move. Okay, so price rockets down, and then there's some orders that are left behind. They want to be filled in. People are wanting to get in at a price that is discounted, okay? So they want to get in below this discounted zone and then continue lower, okay? So in a nutshell, that's what supply and demand really is. That's how I see it, okay? So what we're going to look at now is the schematic of supply and demand. So we've got a range in the market. Now, this range here, let's zoom in. This range where the market is just bouncing up and down, okay? Price is just buying, selling, buying, selling, buying, selling. It's pretty much stagnant, okay? Nothing really crazy is happening. Now, that is where, people are trading nicely. They're simply just bouncing from one end to the other. However, when the demand, okay, takes control, okay, we then have a big buy, okay, and that blows out all of these people that are in this zone, okay. They're buying, selling, and suddenly they get completely blown out. Now, if I can explain to you guys, and I don't know, a lot of you guys, I'm sure, have seen this before or been in this situation before. A lot of people, when there's a range like this, they're waiting for a break out of this range, right? And so what they do, okay, in a lot of situations is they wait for price to break out of this range, okay, to take their position higher. Now, they'll have their order sitting right here, okay, and it breaks out and they buy and they buy and they keep buying and they see this big move and people are buying here, okay, because they're like, wow, okay, this is really shooting up. We're going to see it continue to go. It's broken out of this range and they start buying right here, okay. Then what happens, guys? This just retraces. They have their stop losses sitting down here and they get taken out, Okay, so that is basically why this works, guys. It is targeting the people that are trading breakouts here. Okay, so they're waiting and they see this big move happening. It's breaking out of this zone and they get in here. Okay, they're getting in here because they've got FOMO. They're like, oh, I'm missing out on this big move. I need to jump in. I need to jump in. And then what happens? Price retraces. Okay, and it takes out their stop losses, their accounts below, all of those things. On the other hand, as well, guys, there is also people that are selling here because guess what? There's a double top here, and they're like, oh, it's going to make a triple top. It starts rejecting here. They sell here. They put their stop loss just above, and it gets taken out completely. And that is more liquidity for the market. Okay. Now, these same people say they get a good move here. Okay. They've gotten in, and great, we got in early. Okay, what happens? Now the position is, say, at break even. They get taken out break even, and that gives even more liquidity for the market to go further. Okay, I hope you guys understand what I'm saying, but essentially, these big institutions and banks are trying to grab as much money as they can so they can push the market in the direction they want to go. So what we tend to see happen is that this range occurs, an accumulation, okay, then we have a catalyst. So that could just be a move in the market, but it could also just be like a news event. We could have NFP, we could have CPI, any kind of news that pushes the market aggressively up. So that's our catalyst. Then the market comes back to rebalance. Okay, what did I say earlier? The market leaves behind a whole bunch of people that want to get in at a cheaper price. Okay, it's gone up and they're like, but I don't want to get in now. So these big institutions and banks want to get in at a better price. So the market has to come back down to rebalance. Okay, at one point or another, price will come back down to rebalance. So that's what we're waiting for there. And of course, price does come back, and oftentimes it'll come back to the 50% zone of this, and that's what we like to trade. I'm going to show you guys, areas that are likely to have a reaction with this kind of setup in a bit as well. So now we've gone through what is supply and demand and how it works and why it works. We are now going to go on to order flow. Okay, so now that we've gone through what supply and demand is, and you guys understand why it works and how it works, you must understand that the market works just like this. We've got the range, so now you can see it on a more of a order flow perspective. So that means that the price bought, it left people behind, and they want to get in at a cheaper price and drive the price higher. Okay, and now the price has gone higher. Now, something I want to bring your guys' attention to. In order for there to be a supply and a demand, there must be a break of structure. Okay, that is vital. Break of structure is 100% necessary for there to be a supply and demand. So right here you can see there's a break of structure. There's a break of structure here as well. Okay, there's a break of structure here. And guess what? When there's a break of structure, oftentimes the market will come back to revisit these zones. It'll come back to revisit this zone. Okay, there's a break here, revisits this zone. Okay, and so that's what we're looking for. And in this case, price could also come back down and revisit this zone here. Okay, so that is what we're looking for. We're looking for price to create an order flow. Okay, basically where people are trading in these discounted zones, okay? And we're going to identify exactly where those zones are in just a minute. So now we're going to have a look at what creates a valid zone. Now we know why it works, okay? And why market structure is created like this, okay? And why it moves in this manner. But now we're going to look at what we would consider valid zones to trade from, okay? So like I've said before, in a bullish example, price is going to impulse up out of the range that's created. Okay, and then obviously the market's gonna want to become rebalanced. So we've got an option. Okay, we've got the option of getting in at the bottom of the move. Okay, where the demand was created in this example. okay, and that is usually a bearish candle, okay, before the move that creates, okay. So say this is a bearish candle here, and this is the big move, okay. This would be our demand zone, okay, where price is going to come back down to, okay. That's a very messy drawing, but here there would be a bearish candle, okay, and that would be our demand zone, and we would wait for price to continue to come back into this demand zone and then go forward. Now, the alternative to this is trading off of the range itself, because sometimes price doesn't come all the way back. Okay, it doesn't come all the way back to our refined zone. Okay, sometimes price just taps into the range that's created. Okay, and then it goes. One thing you guys need to remember is that this range on a higher time frame is in fact just one candle. Okay, so basically this could hold some weight on the higher time frame, and price could tap into it and go. Now you have to decide and test this to decide whether you're going to use the range, okay, on your entry time frame as the catalyst to go as your basically your demand or supply zone, or if you're going to use a single candle. Okay, it's up to you. The single candle obviously has a much higher risk to reward. Okay, because if, for example, I get in at this zone here with my stops just below and I target the highs, I've got a 1 to 2. However, if I get in here, my stop loss is going to be a lot fatter. Okay, and obviously my risk reward is going to be tiny in this instance. Obviously, not a real example, but you understand the picture that I'm trying to paint. So here's a bearish example of it as well. You can see price comes back into the discounted zone, okay, and then price sells off from the supply. But then, of course, in a different scenario, okay, we've got price here that just taps in, okay, just taps into the range and then goes. Often when there's a big move, okay, with a lot of momentum, and that's one thing we actually want to look for is a lot of momentum, price will just go like crazy, and then it will come in and go straight off of the range. Okay, it's going to just tap into the top of the range and then go. These are two different scenarios that you need to test, and you both are going to be profitable, but you need to choose one and stick with it. Okay, you need to choose one and stick with it so that your edge plays out. Right. So, what makes it a valid candle or zone to trade from, right? So, I've spoken about, we want a bearish candle to trade off of for a demand zone, okay? But there's different ways. And then obviously for a supply zone, we're looking for a bullish candle followed by that big move. So, here are some examples, okay? So, again, we've got the range, like I spoke about earlier, versus single candles, right? So the range, okay, we would of course be looking for the range, which will be right here. This is the range. Price is just literally, it's just messing around here. And then we've got the big move. Okay, we've got the big move. And now we're looking for the bearish candle, okay, or the bearish move just before, okay, just before price takes off. And of course, the bearish move is right here. Okay, this is the bearish candle. And obviously, we're looking for price to come back into this zone and then just take off. Okay, so price will just trickle back down, collect orders, and then take off from this zone. However, guys, if there is a lot of momentum in the market, okay, so let's say this is a really big move, okay, and we're wanting price to come back to this zone like in the previous example, but often what happens is it will come to the top of the range and then take off, and now you're sitting here with your your buy limit and you got missed. So it's up to you how you want to do it. If you have your buy limit at this zone, okay, that's more refined, you're going to have a higher risk reward, but you're going to get missed out more often. Okay, it's just something that you have to deal with, okay? If you choose to do it this way, do not chop and change. Make sure you test it out, guys. Um, In my case, I wait. I am patient and I wait for this zone to be hit, okay? Because I want to get in at the best price, okay? But it's up to you. It's up to your risk appetite, firstly, and secondly, are you willing to wait for those A plus setups? Okay, I would recommend waiting for the A plus setups. You can, of course, though, still use the range, especially if you see that there is a big push relative to where price was. Okay, because then you're a lot more likely for price to just tap into this. Okay, because on the higher time frames, this is just one candle. Remember that this is one candle. We're going to talk about this in a different module a bit later. Okay, so obviously in a bearish example as well, um, this would be your range. Okay, and obviously price would tap in here and go. Okay, it could also, like I said, just literally wick in here and go. Okay, which is why if this has a lot of momentum, you could then just set your limit at the top of the range. However, if you want to get in at a better price, we're going to be looking to get in here. Okay, which, like I said, you'll get missed out more often. However, it's up to you and your testing to decide what works best for you. Okay, these are the two different scenarios, and I'm just giving them to you so that you can figure it out for yourself as well. So let's move on and look at the different types of supply and demand as well that are presented to us. Let's say, so basically, guys, you've got buy to sell wicks. Okay, now buy to sell wicks. What did I talk about earlier? Supply and demand can sometimes look like this. Okay, a push down and then a range. Wait, let me draw it better. A push down, a range, and then another push down. Okay, and then we would then obviously trade off of this supply zone. Okay, now if we go up a time frame, guess what it looks like? Okay, it looks like this. Okay, so look what price would have done here. We would use this as our buy to sell wicks. Okay, this is our buy to sell wicks area. Price could tap in here and continue going down. Okay, it's a very likely scenario because, like I said, it is essentially this on a lower time frame. Okay, and we would trade off of here. So essentially, guys, what we would then do is have a look on the lower time frame if we saw this, and you would be able to see right now that it would look like something like this. Okay, price continues down, and then it ranges and then comes down even lower. Okay, and then we could trade off of this demand. So that is buy to sell wicks, guys. So you can trade off of this. It is a different type of supply and demand. Obviously, it works both bearish and bullish examples. Now, one thing I want you guys to notice with all of these drawings, what one thing do they all have in common? Whoops. They all have a break of structure. Now, structure was created here, structure was created here, structure was created, whoops, structure was created here, and structure was created here. This aggressively breaks that structure, okay? This break of structure is key to having this as a supply zone here in this case, and this is obviously a demand zone right here. Well, it would actually be this candle right here. So there must be a significant break of structure before, okay, we can consider this to be a valid zone. Okay, just to summarize, guys, there must be a valid, okay, break of structure, okay, before we can consider this below the break of structure, the move that created the break of structure here, this downward move where the break of structure originates from becomes the, in this case, demand zone where we can trade off of. Okay, so if there is some messing around here, okay, not as valid. Why? Because this is above the break of structure. We want to go for this zone in the discount that created the break of structure. Okay? I hope that makes sense to you guys. So let's continue. Another example of supply and demand, okay, after buy to sell wicks are large wicks. Okay, large wicks, again, break of structure, okay, then an impulsive move, okay, and we want price to come back. But where are we going to, take the zone from? Because we can't take the whole candle, because the candle, obviously, with the wicks is quite large. And if we want to refine this, we can refine it just to the wick. Okay? Why? Why can we just use the wicks? Because firstly, there was a break of structure. Okay? And if we refine it to the wicks and we look on the lower time frames, what we will find is that price came up, ranged around here, and then came down. So guess what? If we refine to these wicks, that's what we're refining to. We're refining to the range, once again, on lower time frames. So again, guys, price is fractal. When you see this on a higher time frame, just remember on the lower time frame, there's always stuff happening within these candles. Okay, so if this is on the 4 hour, there's obviously 4 1 hour candles in there. Then there's also, I think, what, 16, 16, 15-minute candles in here. Okay, and it's all ranging if this is on the 4 hour time frame. So we have the range within this candle, and then it goes down. Okay, so obviously we're going to trade the range. We're not going to trade the whole candle. And so that's another way to trade supply and demand, another way to identify it and draw it. Okay, so that is how to identify supply and demand. We've gone over, what supply and demand is, obviously. Just remember that there must be a break of structure first, a break of significant structure, and a really large impulsive move. Okay, we can't have price ranging everywhere because we want the market to reveal its hand first. The market will reveal its hand, and then we will know where we're going to go. Okay, we need to know that. Let me show you the diagram once again. We need to know that the market is done ranging now and the impulse has happened. And once we know that the impulse has happened, we can now start to create the hypothesis that this is going to continue. Okay, we're going to continue breaking structures to the upside, and we're going to keep the bullish trend in this case. Okay, and price will continue to dip underneath to come for discounted price. Okay, and that is the whole hypothesis of supply and demand. So let's have a look on the charts, okay, and have a look at some examples. So let's have a look at Euro USD on the 1 hour time frame. So as we can see right here, price has broken structure to the downside. Okay, so we've got a break of structure to the downside right here. Now, if we follow price all the way to where it broke structure, so what you can do is take a box from where the break happened and draw it all the way up. We want to get to the origin of the move, okay? Now we can see that this was the orange and this would be the high, okay? This would be the high that theoretically should hold, so we call that the strong high, okay? So this is now strong. Okay, terrible handwriting. So we would then, in our hypothesis, have this as our supply zone, right? Now, another thing to notice is that above here there is also a supply zone, but guess what? There was no real significant break of structure except for this right here. So, in theory, this could also potentially be a supply zone that we could trade off of. Now, let us have a look and see what ends up happening. What do we also notice? This here is a bullish candle, okay, before the aggressive move down that breaks structure. These are some really big candles, okay, that signal that the move is happening and going down. So as you can see, price has reacted to this zone, okay. It is the area where price started the move. Okay, so price started this move downwards from here. Okay, and this is obviously where price has reacted from. Now, what I spoke about earlier, if we go down to a lower time frame, so the 15-minute, what do we notice, guys? What do we notice? There is a range here, guys. There's a serious range that happened on the 15-minute. So basically, guys, what I'm talking about is the ranges that happen on in the market. Okay, on the high time frame, it's just a candle. Okay, it's just a candle going in the opposite direction. But on the low time frame, there is a range. So I just want you guys to remember that for future. So you can see price reacts. Now, obviously, we're on the higher time frame. So just for like a spoiler alert, when price gets to these zones, what I would do is put my alert, okay, at this zone right here. I would put an alert at this zone, and once the alert goes off, okay, then I would start to look for positions lower on the lower time frames, guys, because guess what? If we drop to the lower time frames, for example, the 5-minute, we can see that what did we get? We got a break of structure again on the 5-minute. That's very impulsive from the zone. So guess what? That further, it further confirms to me that the zone would hold. And guess what? We get an even better risk reward if we got in at this range even. Okay, and then obviously we would target the lows, right? But this is all just in theory, and I'm showing you guys what is possible with this strategy. Okay, so now price tags into this. Let's just look at structure for now before I get carried away. Price goes a little higher, still staying sort of within this range. Okay, it does peak a little bit above, okay, which you will sometimes see. Price isn't always going to be perfect. It's not always going to be picture perfect. Now, price is going to come for this low here, okay? Right, so price breaks below. And so now we have confirmed that this would be a strong high, okay, in the market, okay? And so as you can see, price peaked above. Did it in fact break above? It did in fact break above, okay, on this higher time zone. Okay, but as you can see, it reacted here, and within this zone of reaction, okay, we would have had some valid trades. Now, what we would be looking at now, once price has broken structure to the downside, you can see there's also another break over here. So there is a potential zone right here where we can go down to lower time frames and look for more confirmations. There's also a zone right here because it broke structure. Okay, we broke some significant structure here. So obviously, if we go up a time frame, we can see that on the 4-hour, this here would be our zone because it's the bullish candle that caused the break. But obviously, on the 1-hour, there are multiple different little breaks that happen. So as you can see, price is indeed fractal. Okay, so you can see that here's an example of when price goes like crazy. This here is the range, okay? The range that happened right here, okay? Price didn't even come into this range, but you could actually technically count this as the range, okay? As well. It doesn't even touch, okay? And then it goes. And often price will do that, but let's see if price makes a little bit of a deeper pullback, okay? And now it taps into the range, okay? And then there would be a lot of people that got in here on FOMO and they would have gotten wrecked a little bit. So price literally wicks this range and continues lower to create lower lows. Okay, so obviously that did not happen, and price continued to go higher. Okay, so guess what? We would be still looking for price to come into one of these zones, most likely this zone here, and react. Okay, in theory. So let's see what happens. And there you go. So price came back in, and now guys, like I said, the market is looking for premium and discount. So if we draw from the high to the low, we can see that price retraced into a discounted area, okay? This is below the 50%, okay, or above the 50% in this case. And then we had the reaction, okay? Now, if we go into a higher time frame, we can see that there was actually an imbalance at the zone, and we'll talk about that a bit later, and that's what caused this move. Okay, so you guys can see that the market works in a flow, okay? So price broke structure, came into the demand, came downwards, broke structure, came into another area of discount. It obviously didn't come into our area of demand just yet, and then it continued down lower. So what you will find is that when price breaks structure, it wants to retrace, okay, and come back. Um, and it wants to come back because it's looking for an area of demand, okay? And so once price breaks structure, okay, to the downside, we can then assume that the highest point that broke structure, which would be here, is safe, okay? It is strong, and the weakness, the bottom of this move needs to be taken out. So for example, here it breaks structure, and we would be looking for price to come back in, and here is our supply area that price could sell from and continue lower and break structure once again, okay? So that is what I would be looking for. Obviously, guys, we would be looking for confirmations of this. And so here price continues without us. Again, guys, here is an example of a range, okay, that is created where we're looking for price to come back into this range, which is a supply on the higher time frame, and continue lower, okay? So let us see what happens. Price taps into this zone and reacts, okay? So again, let's see if it breaks the low. It does. So you guys can see how this works, okay? Price really does like to move into an area of discount, okay, and then push lower. Now you'll see that price will want to more than likely push into an area of discount again, which would be here, and continue lower. And that is how the market moves, guys. So there you go. It pushed into a bit of a discount with a little pullback, broke structure, and continued lower. Okay, so guys, as you can see, price likes to move from supply to another supply to another supply. It breaks structure, another supply. Break structure, it's looking for another supply or a discounted zone to trade from. Okay, so now we're going to move on to the advanced stuff. Okay, so imbalance and fair value gaps, right? So imbalance and fair value gaps are simple. So I've spoken about imbalance and fair value gaps quite a few times. So an imbalance is simple. If we look at the most recent price action, an imbalance is the relationship between three candles. So we've got, let's say we're looking at these three candles here, these three red candles. We've got candle 1, candle 2, and candle 3. Okay? Now, we want to look at the relationship between these three candles. So we look at the middle candle. Now, is there a gap between candle 1 and candle 3? Yes, because this top wick and this bottom wick are not touching. So there is a gap in the middle here where price has not yet returned to. They tried to come up higher here, but it didn't. It continued lower. So price often will want to gravitate towards that. And so you can see price came into this gap and it reacted. So if we look on the 1 hour time frame, you can see price came into this gap that we had marked out on the 4 hour. So let's go back. This is the gap. Price came to fill it in. And if we go into the 15 minute, as you can see here, price came in, filled the gap, and continued lower. Now, obviously, it's wanting to go a bit higher, but you can see in this case that it did actually react to this zone. Okay, so that's what a fair value gap is. Now, what we would like to do is have this fair value gap paired up with a supply or demand zone. Okay, and so that's where the confluence starts to come in, right? So this is the supply zone. Now, there is a fair value gap here. There is additionally another one right here, okay, as you can see. So this is the FVG. So let's see if price will often react to the FVG, fair value gap, or area of imbalance, okay, before it even gets to the zone. So it's like an extra area of resistance, okay. So let's see what happens in this case. Price reacts straight from it, and it does tap into this area of supply it just misses it. So you must also bear in mind that sometimes this imbalance zone will be an area that it just immediately reacts from, and it comes a bit higher and taps, just grazes into the zone, okay, into that supply zone, and there you go, it goes lower, and this is where price is currently. So you guys can see this is the FVG, or the imbalance, okay? And then it came for the last bullish candle before the bearish move. Okay, this is a very impulsive bearish move. Here is your break of structure, okay? Now you've got your imbalance and you've got your order block up here, okay? Your order block or supply zone. Like I say, ICT, it overlaps with supply and demand trading. So you can see here, this is on the 4 hours. So you can only imagine if you were on the 15-minute, okay? You come into the zone, okay, which it has tapped into the zone here. Let's get rid of the FVG. It taps into the supply zone, okay. Then we're looking for, after the tap, we're looking for another break of structure, okay, like so. This breaks structure impulsively, and then guess what, guys? We're then looking to get in on the 15-minute order block, which would look, obviously, the green move before the move comes down and breaks structure. So what I like to do is include the wick at the top, okay, and then obviously we would get in when price taps into the order block, okay. I like to give an extra pip above, and then we target the weak low, okay, which would be this area down here. And that is a 5.78 risk reward. Okay, and what some people like to do is just hold it, because obviously if you look at the higher time frame, there's a very long trend of bearishness. Okay, and this is where price is currently, actually. So this happened, today. So yeah, so that is the power of including fair value gaps and imbalances in your trading, okay, when it comes to supply and demand trading. So now, okay, we're going to look at supply and demand flips. Okay, so supply and demand flips are simple. Okay, simply, let's have a look at this example we were just on currently. What we would be looking for is, let's go back slightly. So supply and demand flips would essentially necessitate that this supply would be flipped. Okay, so what this means is that price would come and tap into it. Where does it tap in? Why did it not tap in? Okay, so in this zone, this example's not brilliant. So we actually have an example of it right here. So this zone right here, whoops, it'll be the bearish move before the bullish move up. You can see price taps into this demand zone, okay? And then price just completely violates it. Now, what we would be looking to do is, once price, okay, comes and makes this demand fail, we would then look to get in on the supply that caused the demand to fail. And this would be a supply demand flip, okay? So this zone actually becomes a lot stronger once this demand is flipped. So we would then be looking for price to continue to come up, and it could still very well happen that price comes up into the zone, taps in, and continues lower. Okay, and that's what we would be looking for. Now I can show you a whole bunch of other examples right here. So as you can see, guys, price came up here, broke structure to the upside, and this would now be our demand. Okay, price comes in, there must be a reaction to the demand, it trades up a little, and then it violates this demand. Then what, guys? Then we would be looking for price to come back into this zone that caused the failure of demand, okay, to come lower. Obviously, in this case, it doesn't come up high enough, okay? But you'll see now that when it does come into these zones, it's very, very powerful, okay? So in this example right here, you can see that price has broken structure to the upside, okay? And now it reacts to this demand zone, okay? Then what you can see is that it comes through, okay, and it fails, okay? So for this example right here, it reacts, comes through, fails, and now it's reacting to this zone right here. And like I said before, you can also use the wicks, okay? And so right here, you can see that you could have traded this on the lower time frames, okay? And that is basically supply to demand flips, okay? Now, I could continue on with lots and lots of different examples, but basically that is what a supply to demand flip is. So let's have a look at just one more, okay? So you can see here, price broke structure here, created this supply, price reacts to the supply here, okay, there's a reaction, and it continues higher, completely violates it, comes back down into this supply, and then continues to go higher, okay? So supply to demand flips are extremely powerful because you can see how far this moved, and especially if you got into this on the lower time frames, okay? So that is supply to demand flips. Right, let's clear our chart. Now we're going to look at multi-time frame structure, okay? So multi-time frame structure is simple. You do not want to be in the middle of nowhere, basically. You want to make sure that when price breaks structure, okay, to the upside, for example, here on the higher time frame on the 4 hour, that you're not getting into positions up here to go long because you're in the middle of nowhere. You want to get in at a discounted zone. So down here, okay, you want to. So if we draw our discount and premium tool, you want to make sure that you get in at this point, okay? At this point right here, you want to be getting in, okay? Because that is where price is discounted. And then on the lower time frames, we would be looking at obviously this imbalance here and this demand zone right here, okay? The same for what just happened previously. You know, the break happens here. Obviously, we've got internal breaks right here. And so we would then be looking, okay, for the exact same thing continuously, like just on the last example that we went through right here. This is the demand zone, okay, that obviously gets respected because you can see here that there is a range, okay? So price reacts to this. Obviously, on the lower time frames, you would be looking for a confirmation, okay, which would be obviously the exact same thing, but on a lower time frame. Once again, you can see that demand here gets respected, okay? Demand here gets respected. And as soon as you come into this zone, you drop down to the lower time frame and then you look for your entry. You're not looking to get involved when price is breaking structure here. So you on the 1 minute time frame and you're seeing, you're seeing your supply and demand, okay? But actually you're up here in the middle of no man's land. You need to wait for price to get down here on the lower time frames. I recommend the 4 hour time frame for my higher time frame confluences. And then what I do is I look to get in on the 1 minute time frame for these lower time frame plays, guys. So let's go have a look at basically putting it all together. Right, so if we had to put these confluences together, I'm here on euro dollar. Basically, we can see this big impulse to the downside. We can see that it broke structure, okay, and it's a very impulsive move, okay. What happens? It creates a supply, right? So this supply here is what we would be looking to trade short, okay. And so price taps into it and we have a reaction to it. Okay, that's the first thing. Now, ideally, because if we look back, price is, creating higher highs, higher highs, and a higher low now. So actually, what we would technically be wanting to see right now is this supply fail, create a higher high, okay, and then come back in and tap into a zone that potentially gets created here, a demand zone, and then we go long, okay? Now, let's see what happens in this instance. Price completely goes up, okay? Now, we're going to now put our tools that we've learned about to practice, okay? Now, what do we have here? We've got an imbalance, okay? This is an imbalance or a fair value gap, okay? Price has not yet come back here. This is a fresh zone, okay? So that is a very good indication that price is going to come to this zone here, okay? Tap in, okay, because this is before price firstly broke structure here and it violated this supply. So we've got a whole bunch of confluence that price is going to come back to this range here, okay? Now, like I say, depending on how bullish this is, we can either play the range or we can play the demand zone, okay? So as you can see, price is actually going insane. So in a case like this, okay, I would actually potentially look to play this demand, the entire zone, because it's gone so far. Okay, so then I would then hop in long here with my stops just below. Okay, I'd give myself a little bit of room here just for in case I don't get tagged in. And so let's see what happens here. Price tags us in, and then we continue the move upward. Okay, and there we go. We continue the move upward, and this is a 5.6 risk reward trade. Okay, and we can see that because we use the confluences of the fair value gap, okay, or imbalance, and we use the confluence of the flip, okay. Whoops, this is the flip, okay, and the fair value gap is here, okay. So we got the flip and we got the fair value gap. It makes this zone extremely strong, and you can see it reacted very well to that zone. So that's putting all of the confluences together that I've taught you about so far. All right, guys, so that's about it for this very lengthy video. We've gone through a lot. I hope I haven't gone too fast for some of you. But yeah, I go into a lot more detail on this in my Discord group that you can join. The link is in the description. But yeah, I hope my thoughts weren't all over the place too much for you guys. But this type of trading is extremely lucrative to do. And if you get a grasp on this properly and you know where you are, firstly on the higher time frame, you're able to put together the three confluences that I've given you guys, and you can see the patterns that are created by the market like this. You guys can turn this into an extremely, extremely high probability, high risk reward trading strategy. So that's about it from me, guys.
So I want to thank each and every one of you for watching this video. A lot of you, like I said, aren't subscribed already, so I would just like to request that you guys hop below and subscribe to the channel, as well as leave a comment on what you want to see in future videos or what you thought about this video. Thank you so much for all of your support this far, guys. This channel really could not do it without you. So thank you for your support, and I'll see you in the next video.